Welcome. My name's Steve Beck. I'm going to give you an introduction to alternative investment strategies. My background, I'm a chartered financial analyst, a certified insolvency and restructuring analyst, a certified management accountant. I am an owner and operator of an international hedge fund that deals in US-Japan investments and diversified strategies. We've been involved in the past in restructuring distressed companies. And then finally, I've also done international real estate investing. So I'm well qualified and versed in this area and topic. And I'm very excited to introduce this to you. Alternative investment strategies ultimately are here for diversification reasons. The reason that we are all interested in alternative investment strategies is to try and maximize the return while reducing the risk to the portfolio. Modern portfolio theory states that we're going to have an efficient frontier. The efficient frontier is the return on the y-axis, and on the x-axis we're going to have a level of risk. What we want to do in the efficient frontier is, if this is a portfolio and it's an efficient portfolio of stocks and bonds, and this is the risk-return line that's constructed from the efficient portfolio, by diversifying into alternative investments, the hope is that we can actually move this efficient frontier upward and to the left. Now, why this is important, this upward and left movement, is because by moving this line over to the left and upward, we can see that the return for given levels of risk improves. So, for example, if we were to take this point here, point A, that this level of risk is giving you a return. Let's call this level of return 15%. For a given level of risk, we're getting 15%. If we move this efficient frontier upwards and to the left, you can see the level of return has increased by 200 or 300 basis points, or 2%, 2 to 3%, for the same level of risk. Alternatively, point A not only increases the return for a given level of risk, but if you keep the return at the same, you're able to move your level of risk down. So you can keep your level of risk low, get your level of risk lower, keep the return the same, or alternatively, keep the level of risk the same and increase your return. And that's really what modern portfolio theory is all about, the efficient frontier is all about, and what the diversification implications of alternative investment strategies offer you. Moving on alternative investments to classifications. Really what we wanted to do right now is determine what classifies an alternative investment versus a standard investment class. For example, you have your stocks, you have your bonds. Obviously, those are a standard investment classification, and we all understand how the implications of those. Now let's turn to alternative investments and try to determine what makes an alternative investment an alternative investment by classifying them. The first classification we're going to look at is an illiquidity. Illiquidity is one of the key drivers of an alternative investment. How do you get in? How do you get out? Is there a market for this investment, or is there not? That's really determining what the liquidity of the stock is and whether it's going to be an alternative investment or not. Fair market value. Is there a fair market value? Is there not fair market value? How do I quantify the fair market value of the stock or investment? Alternative investments are typically very difficult to quantify as to what their fair market value is. Limited history. Very difficult to even find history on a lot of these investments. We can't get any data. The data that is presented is sometimes skewed one way or the other. There might be biases in this data. It's very difficult to determine what the risk return is of this data. So the history is limited, and the history that you actually are able to obtain is skewed. And the final point that is really a classification of all alternative investments is extensive analysis is required. That really goes to, you can't just look up the investment in the New York Times or the Wall Street Journal. You actually have to go out into the marketplace, do your investments, spend a lot of time, effort, money, trying to determine what the investment is, how to quantify it, what the entry and exit strategy should be. So the way that investors get around these 4 points is they demand a higher rate of return. Rarely you're demanding the higher rate of return because it's illiquid, because you can't determine the fair market value, because of the limited history and extensive analysis required. And the question that you probably want to ask yourself is, do I need a return premium on this investment? If so, why? Is the return premium because the investment is illiquid or because the fair market value is not able to be determined? I mean, it's sort of obvious when you really start considering each one of these classifications, but you need to know this so that you can understand what's driving an alternative investment strategy. Now, investments that we're going to look at during this course, there's just numerous alternative investments available. We're going to look at the basic alternative investments available. We're looking at the commodities market. We're looking at the real estate market, the hedge funds, distressed companies, and private equity. There's a lot of other different types of alternative investments that we won't be addressing here, such as stamps, art, your various investments that, as we just discussed, under those classifications where they're illiquid, hard to identify, hard to determine fair market value. Stamps, for example, or art. You'd wait for the Christie's hammer to go down and then try to establish what the value is at that point in time. So we're going to stick away from those and stick with the more mainstream alternative investment strategies and assets that are available. And the first one we're going to turn to is investment companies. Investment companies can either be unmanaged or managed. Unmanaged, you've got a fixed pool of assets. They are really, what happens here is the portfolio manager goes out, he acquires a pool of investment funds under the guise of, I'm going to be buying a fixed pool of assets. They go out, they purchase that fixed pool of assets, and at that point in time, it's fixed for the life of the investment. And once the investment matures, everybody's refunded and hopefully gets a good level of return. Managed funds, you can either have open-ended or closed funds. Open fund, of course, what happens is investors can come during the life of the fund, invest in the fund, and then remove their assets from the fund at any given point in time. Here they're actually buying into the fund itself, so the asset manager will acquire or sell shares in the fund to the public. Closed-end fund is slightly different in the fact that, once again, it's a pool of assets or investments, much like a fixed fund. So both of them have a fixed pool of investment amounts. However, in a closed-end fund, this is typically a fund that's traded on the open market. You can redeem your investment or shares that you've been issued by the fund on the open market, and you're able to then buy or sell these shares. And we'll discuss the implications of an open-ended and a closed-end fund in a little bit more detail later. But typically your open and closed-end funds, they're both mutual funds or some kind of mutual fund investment where one, as I say, you redeem directly from the investment pool, the actual company itself, the mutual fund itself, and on the closed-end fund, they are not the redeemers. The redeemers is a third party on the stock exchange. And we'll discuss the implications of both of these in a second. Let's look at the development of these investments over time. These investments are not static. They're completely available to the public as a demand and supply issue. As the public demands new alternative investments, they're delivered. On top of that, investment banks are trying to offer new alternative investments to the public. It's a supply-demand issue, and it's really a product issue.